for class 12 CBSE syllabus. We have been dealing with the chapter number 5, that is admission of a new partner, right? And today what we are going to learn, accounting treatment of reserves and accumulated profits or losses. Before I proceed further, let me tell you something about it. Okay, as you know that we have already finished the chapter number 4, that is change in profit sharing ratio among existing partners. Okay, initially I told you a firm is reconstituted due to various reasons. Out of those reasons, one is whenever there is a change in the profit sharing ratio, and another one when a new partner is admitted to that firm. Okay, so more or less similar treatments are done from accounting point of view in both these cases. Okay, so as many things we learned at the time of chapter number 4, most of the things are going to be the same here in that case also. Okay, because whenever the firm passes through the process of reconstitution, then the similar accounting treatments are done. Okay, here also we will prepare revaluation account. Here also we will do the adjustment of reserves and accumulated profits or losses. Here also we will prepare partners capital account and balance sheet. Only a bit difference will be there. Okay, so in today's video I am going to explain you, or I should say I am going to remind you what you learned in chapter 4 related to the same topic, because the same is going to be applied in the case of admission of a new partner as well. Only a few things will be different. And what are those? I explain you. Okay, in place of all partners, we are going to use old partners. How? Let's understand. Earlier the profit, reserve, losses, everything was being distributed between or among all partners, because they were just changing the ratio. They were not going anywhere, and nobody was coming new one from outside. But in this case, what's going to happen? The new partner is going to come, okay, who has no relation with these profits and losses, assets, liabilities. Okay, so that is why the distribution will be done only between or among the old partners. Understood the point? So in today's video, you will be learning all the theoretical concept. Numerical problems I will be tackling in the separate videos. Once all the theoretical concepts are over, then I'll start tackling the numerical problems based on all these adjustments, whether these are related to this topic or further topic. I'll make the video on numerical problems later on. Alright, so without wasting much time, let's recall or understand again what we learned in chapter number 4 related to this, but with the point of view of admission of a new partner. Okay. So friends, as I told you, at the time of admission of a partner, accounting treatment of general reserve and accumulated profits or losses is as similar as we studied at the time of change in profit sharing ratio among existing partners. Only what the difference is, there we were distributing everything among all the partners, but here everything will be distributed among only old partners. Always keep this thing in the mind. So let's move further. See, if at the time of admission of a new partner, reserves and accumulated profits or losses exist in the books of the firm, they are transferred to the old partner's capital or current accounts in their old profit sharing ratio. Understood? Next, because reserves and accumulated profits or losses as on the date of admission of a partner were earned before the reconstitution of the firm. Okay, already we have learned, if any partner comes in a firm, then at that point of time the firm is reconstituted. Okay, and as many reserves and accumulated profits and losses are there in the books, these belong to old partners. The new partner does not have any right. That is why these are supposed to be distributed. Okay, so now let's move further. Journal entries. So for transfer of general reserves and accumulated profits, and for transfer of accumulated losses, we'll be passing the separate entries. You can compare these entries with the entries that we learn in the same case at the time of chapter number 4, change in profit sharing ratio, right? Only the difference you will find that in place of all the partners, here it is written old partners. All right. So in case of profit and reserve, what entry will be passed? Reserve, general reserve account debit, profit and loss account debit, credit balance to old partners capital or current account, being the reserves and accumulated profit distributed among the old partners in old profit sharing ratio. Fine. Now in case of loss, old partners capital or current account debit to profit and loss account debit balance to deferred revenue expenditure account, means if any kind of deferred revenue expenditure or fictitious assets like advertisement expense account etc is there, so that will be credited here, being the losses distributed among the old partners in old profit sharing ratio. Fine. Now let's move further. Accounting treatment of specific reserves in various cases. I told you that specific reserves are also there. So there are two kinds of specific reserves in your syllabus. Everything is same like we did in chapter 4. Okay, see, workman compensation reserve. It is a specific reserve set aside out of firm's profit to meet possible liability to pay compensation to employees if it arises. Fine. It means a claim may or may not arise. We already know that. It also means that claim may be equal to or lower or higher than amount of reserve. Okay. Now let's talk about investment fluctuation reserve. It is a specific reserve set aside out of profits to meet fall in the market value of investment. It means fall in the market value may or may not occur. It also means that the fall in the market value is equal to or lesser or higher than the book value. Okay. It is also possible that market value increased instead of falling. See, all these cases theoretically as well as with numerical we have discussed in chapter number 4. Okay, so I'm not repeating here. I have just read it out. Later on I'll be making the separate video, as I have already told you, for full-fledged numerical questions. Okay, let's move on. Journal entries related to workman compensation reserve in various cases. So the case 1 is there when claim against workman compensation reserve does not exist. When there is no claim, then what happens? Workman compensation reserve account debit to old partners capital current account. Earlier in that case, chapter number 4, we were writing here all partners. But right now we will write only old partners. Fine. Being workman compensation reserve credited to partners capital or current accounts in their old profit sharing ratio. Fine. Now case number 2, when claim against workman compensation reserve exists. So there are 3 possibilities. In case 2, when claim is equal to the amount of WCR. So in that case, WCR will not be distributed among the partners because the entire amount will be utilized for the purpose of claim. So the entry will be workman compensation reserve account debit to provision for workman compensation claim account, being the provision made for estimated workman compensation claim. One more important point is here, I told you in chapter number 4 as well, when claim for workman compensation is determined or accepted, it becomes a liability. Okay, in this case, workman compensation claim account is credited instead of provision for workman compensation claim account. So you'll have to see in the question, if the question says that the claim has been determined or accepted, then it becomes a liability, not provision. Now let's move on. Case number 2, when claim against workman compensation reserve exists, and the possibility number 2, when claim is lower than the amount of WCR. So in that case, we are having the claim lower. So the remaining surplus will be distributed among the old partners, not all the partners. Understood? Workman compensation reserve account debit to provision for workman compensation claim account to old partners capital or current account. Okay. Being the provision made for estimated workman compensation claim and surplus of WCR transferred to partners capital or current accounts. Now let's move on. Last possibility in case 2, when claim is higher than the amount of WCR. So in that case, the partners have to arrange the extra amount. Okay, say for example, the reserve is there for 30,000, the claim they have to pay for 40,000. So 30,000 will be compensated from the reserve account, but what about the remaining 10,000? That will be arranged by the partners. So for the temporary period, this amount will be kept under revaluation account, and then further it will be shared by the old partners. New partner has nothing to do with this. All right. So workman compensation reserve account debit, revaluation account debit to provision for workman compensation claim account, being estimated claim debited to WCR and revaluation account. And now you see the second entry, old partners capital or current accounts debit to revaluation account, being loss on revaluation transfer to capital or current accounts. Alright. Okay, now let's move on. So it was all about the WCR. Now we are talking about investment fluctuation reserve. This also has various cases. The case number 1, when book value and market value are same. I have already explained you why this reserve is maintained in chapter number 4. I am not repeating here. Okay, so this is made only for compensating the amount of fall in the value of investment. But when there is no fall in the value, means book value and market value are same, then the entire amount of reserve is distributed among the old partners. Only this is the difference here in comparison to chapter number 4. Being investment fluctuation reserve credited to partners capital or current accounts in their old profit sharing ratio. Understood? Now case number 2, it has 3 possibilities. When market value is less than the book value, right? Okay, means in your books investment shows, say for example 1 lakh rupees, and in market its value is 70,000 rupees. Okay, and you have maintained some amount of reserve for that. Now there are 3 possibilities when this fall in value is equal to the amount of reserve you have maintained. The very first possibility, let's understand this. Okay, investment fluctuation reserve account debit to investment account. Say for example you maintained the reserve for 30,000 and 30,000 is the fall in the value of investment. Alright, so in that case entire amount of reserve will be utilized for compensating the fall in the value of investment, and for the same the entry will be passed. Alright, being the fall in the value of investments was set off against IFR. Now let's move on. The possibility number 2 in this case, when fall in the value is lower than the amount of IFR. If you maintain the reserve for 30,000 and the fall is there of 20,000, so remaining 10,000 will be distributed among the old partners. What entry will be passed? Investment fluctuation reserve account debit to investment account to old partners capital or current account, being fall in the value was set off against IFR and surplus of IFR transferred to partners capital or current accounts. Understood the point? Now let's move on. Possibility number 3 in this case, when fall in value is higher than the amount of IFR. Now this is a case of loss, so in that case the partners have to bear this loss. I just give you example. Suppose the reserve is there for 20,000, the fall in the value of the investment is 50,000, so 10,000 has to be arranged by the partners. So for temporary period this loss will be capped under revaluation account, and later on this will be shared by the old partners, not by new partner, because new partner has nothing to do with this. Understood the point? So first entry will be passed in that case, investment fluctuation reserve account debit, revaluation account debit to investment account. Being fall in the value was debited to IFR and revaluation account, right? Second entry, old partners capital or current accounts debit to revaluation account. Being loss on revaluation transferred to capital or current accounts. Understood? Now let's move on. The case number 3, yes, the case number 3 is also there in case of IFR, when market value is more than book value, because this is what the purpose for making the investment. Say for example in your book the investment is visible by 50,000 and in market its value is 70,000, so 20,000 is the profit. Okay, so entire amount of reserve, whatever reserve you have maintained, so for example you have maintained 10,000 as investment fluctuation reserve, so there is no fall because this reserve is maintained only to compensate the fall in the value of investment. But as there is no fall, so entire amount of reserve will be distributed among the old partners, being investment fluctuation reserve credited to partners capital or current accounts in their old profit sharing ratio. Understood? Now you see in the second entry, as the market value is more than the book value, it means you are in profit. Okay, so here the investment value will rise, so whenever any asset rises it is debited, so investment account debit to revaluation account. For the temporary period this profit will be capped under revaluation account. Okay, being profit on investment transferred to revaluation account.
Now, entry number third, revaluation account debit to old partners capital or current account. Like they were bearing the losses, now they are getting the profit as well. So being profit on revaluation transfer to capital or current accounts. Understood? Now let's move on. So it was all about the treatment of reserves and accumulated profits or losses in case the firm does not want to retain these values, right? But what if the firm, or we say all the partners, decide to keep the reserves and accumulated profits or losses on the same value in the books? So, what happens in that case? Let's read that. Sometimes the partners may decide that existing balances of profit and loss account or reserve should continue to appear at the same amount in the balance sheet of the reconstituted firm. Means even after the admission of a new partner. However, he has no right in that, he has no share in that. So, how it is going to happen in that case? Let's study further. However, an entry for the net effect of accumulated profits, losses, and reserve is passed since they were earned in the past. The adjustment entry is passed through the partner's capital or current accounts, but the old partner's one. Okay, the gain or the sacrifice of partners is calculated, and an adjustment entry for the amount is passed on the basis of gained or sacrificed share on admission of a new partner. Fine. How? There are following steps to reach over the adjustment entry. Very first, we need to calculate net effect of reserves, accumulated profits and losses. This is similar as we did in chapter number 4. The same case was there in that case as well. Okay, reserves if any, add accumulated profits if any, less accumulated losses if any, and then you get net effect. Calculate gaining and sacrificing ratio. You already know how to calculate that. Calculate share of gaining partner and sacrificing partner in the net effect, right? For gaining partner, net effect multiply share gained. For sacrificing partner, net effect multiply share sacrificed. Pass the following adjustment journal entry. For positive effect, gaining partners capital or current accounts debit to sacrificing partners capital or current accounts. For negative effect, sacrificing partners capital or current account to gaining partners capital and current account. Only one thing is new here in comparison to chapter number 4. Okay, here wherever we are writing gaining partner, it also includes new partner. Only this is a twist here. So whenever we are writing the gaining partner, we will mention the account of new partner as well, right? Because he is gaining the entire share. Okay.
So now you must have understood what is the difference in chapter number 4 and chapter number 5. Okay, and how the things are going to happen. Here also you are getting the workman compensation reserve, investment fluctuation reserve, everything is there. Only difference is this. Understood the point? Okay, so very soon I'll be meeting you in the other video. There also I'll be explaining you the theoretical concept. Okay, and after that I'll be making the videos having the numerical problems based on all these adjustments. Alright, till then, thank you, bye bye.